What if I told you that the recent crash in silver prices is not weakness, but strategy? What if the sharp 40 to 45% drop we witnessed was not simply panic selling, but a calculated move designed to shake out leveraged traders and allow powerful players to accumulate physical silver at a massive discount? Welcome to Gold Silver Scope, where we break down what is really happening in the gold and silver markets in simple, clear language so you can understand the bigger picture. Let us start with the most important issue: margin and leverage. When silver prices were moving fast and attracting attention, many traders entered the market using borrowed money. They were trading on margin, meaning they controlled large positions with relatively small capital. This works very well in a rising market, but when volatility hits and prices fall sharply, margin calls are triggered. Traders are forced to sell, often at the worst possible moment, just to survive. That forced selling creates even more downward pressure. Now here is where things become interesting. A sudden increase in margin requirements can intensify this effect. If margins are raised during a volatile period, smaller traders and even fairly large speculative traders get squeezed. They are forced to liquidate their positions. The price drops quickly. Panic spreads. And within days, we see dramatic collapses that look emotional and chaotic on the surface. But step back for a moment. Ask yourself, who benefits from a 40% drop in price during a heavy delivery month? Who benefits when leveraged players are flushed out and physical metal becomes available at discounted levels? If someone wanted to accumulate a large amount of silver and take delivery, creating a temporary collapse through margin pressure would achieve several objectives at once. It would remove speculative froth, it would reduce price expectations, and it would allow accumulation at what could be called a subsidized price. Some will say this is conspiracy thinking. Others will say the simplest explanation is the correct one. It was just leverage, just volatility, just traders getting overextended. And yes, that is part of the truth. But we must ask a deeper question. Why was the leverage allowed to build so aggressively? Why were margin changes implemented when they were? Markets do not operate in isolation. They are ecosystems influenced by rules, incentives, and powerful institutions. If you wanted to quietly accumulate silver, you would not want the public believing they were sitting on the next big breakout. You would want sentiment damaged. You would want people discouraged. You would want them to puke out their positions, as traders often say. That is exactly what a violent 40% correction accomplishes. It knocks the wind out of the market. Now let us be rational. There is always a fine line between speculation and reality. The simplest explanation often works. Excessive leverage leads to liquidation. But sometimes leverage becomes the tool that enables something larger. When you see a major delivery month approaching and massive volatility combined with rising margin requirements, it is fair to question whether this was purely accidental. At the end of the day, silver is not just a trading instrument. It is a strategic metal. It is critical for industry, technology, energy systems, and defense. When you look at it from that angle, price becomes more than just a chart. It becomes a signal. And sometimes signals are managed. In this first part, the key takeaway is simple. The recent crash does not necessarily mean silver is weak. It may mean the opposite. It may mean strong hands are using volatility to transfer metal from leveraged traders into stronger ownership. And when that transfer is complete, the structure of the market can look very different. Now let us move to something even bigger than margin calls and leveraged traders. Let us talk about government involvement, strategic reserves, and the idea of price floors for critical minerals. This is where the silver story becomes not just financial, but geopolitical. Recently, there has been growing discussion about governments supporting domestic production of critical minerals. The reasoning is simple. Economic security is national security. If a country does not control its own supply of key materials, it becomes dependent on foreign powers. And in today's world, that dependence can be dangerous. Silver is not just used for coins and bars. It is essential for electronics, solar panels, medical equipment, artificial intelligence infrastructure, military systems, and advanced manufacturing. It is a strategic metal in every sense. The idea of a price floor is straightforward. If mining companies know there is a guaranteed minimum price for their product, they are more willing to invest billions of dollars into exploration and development. Mining is expensive. The easy deposits were discovered decades ago. Today, the all-in cost of producing silver continues to rise. Energy costs are higher. Environmental regulations are stricter. Labor and equipment costs are elevated. Bringing a new mine online takes years, sometimes a decade, and requires massive capital. Supporters of price floors argue that without government support, domestic production cannot compete globally. If a country wants to increase sovereignty and reduce reliance on other nations for critical minerals, it must create incentives. That could mean faster permitting, reduced regulatory barriers, tax incentives, or even guaranteed pricing. But here is the critical question. Would a price floor actually hurt silver investors? At first glance, some might worry. Government involvement often brings inefficiencies. Free markets function best when price discovery is natural and unrestricted. If a government sets a floor, could it also impose a ceiling? Could it attempt to control both ends of the market? This is a fair concern. Historically, markets with heavy intervention often distort supply and demand signals. However, silver is a globally traded commodity. It is bought and sold around the world across multiple exchanges and physical markets. Imposing a strict price ceiling would be extremely difficult without massive global coordination. A floor designed to incentivize mining may be easier to implement domestically, but controlling the global market is another matter entirely. More importantly, we must look at the bigger supply-demand imbalance. For the past several years, the silver market has faced a structural deficit. Annual demand has exceeded annual supply by hundreds of millions of ounces. Industrial consumption continues to grow, especially with renewable energy expansion and advanced technology manufacturing. At the same time, global mining output has struggled to keep pace. Even if a government aggressively pushes domestic mining initiatives, it cannot instantly close a 200 to 300 million ounce annual gap. New mines take time, infrastructure takes time, environmental approvals take time, capital investment takes time. This is not a short-term fix. Another major issue is stockpiles. Over the years, strategic reserves of silver have been reduced significantly. In fact, even large government mints must go into the open market to acquire silver for coin production. That tells you something important. There is no massive hidden vault overflowing with surplus metal ready to stabilize prices overnight. If anything, inventories are tighter than most people realize. At the same time, other global powers have restricted exports of critical minerals in recent years. This adds another layer of urgency. When supply chains become weaponized, countries respond by trying to secure their own resources. Strategic mineral reserves, domestic production, and sovereign supply chains become national priorities. So, where does this leave silver prices? If a price floor is implemented to encourage mining, it may actually reinforce the long-term bullish case. It signals that silver is strategic, it acknowledges supply concerns, and it confirms that governments view this metal as critical to economic survival. Yes, intervention is rarely perfect. Yes, markets function best with transparency and natural price discovery. But let us be honest, modern markets are already influenced by policy, regulation, and central bank actions. Silver does not trade in a vacuum. The deeper reality is this: demand continues to outpace supply, stockpiles are thin, and bringing new production online is slow and expensive. Even with government support, Structural deficits do not disappear overnight. Now let us talk about what is happening on the ground, in the real physical silver market, because this is where the story becomes very clear. Many investors look at the spot price on their screen and assume that when silver drops sharply, they will be able to buy physical metal at a huge discount. For a day or two, that may appear true, but very quickly, something changes. Premiums begin to rise. This confuses many people. They ask, if silver just fell 30 or 40%, why am I not getting cheap coins and bars? The answer is simple. When the spot price drops dramatically, value buyers rush in. Investors who were waiting on the sidelines suddenly see opportunity. They place orders aggressively. Physical inventory begins to disappear. Primary distributors and wholesalers are the real market makers in the physical space. When demand spikes and supply tightens, they raise premiums. Retail dealers are not the ones driving these increases. The pressure comes from higher up the chain. If distributors see strong demand and limited restocking ability, they immediately adjust pricing. At the same time, refiners shift their focus. When industrial demand is strong, refiners prioritize large wholesale bars, especially the 1,000-ounce bars used for industrial and commercial purposes. That means smaller retail products like 10-ounce bars and 1-ounce rounds become harder to find. Production capacity is limited. If refiners are busy filling industrial contracts, retail products take a back seat. This creates a very unusual situation. Spot price falls sharply. Investors rush in to buy. Inventory dries up. Premiums surge. And suddenly, the physical price you pay is not nearly as low as you expected. We have seen this pattern before. In 2008, silver collapsed from above $20 to below $10. On paper, it looked like a massive bargain. But in reality, major mints shut down production. Delivery delays stretched for weeks, even months. Premiums exploded. In some cases, if you could find product at all, you were paying nearly double the spot price. We saw a similar pattern in 2020. Spot price briefly crashed into the low teens. Within days, physical supply vanished. Premiums surged. Delays increased. The disconnect between paper silver and physical silver became very obvious. This is happening because the paper market trades enormous volumes compared to the physical market. Futures contracts can be bought and sold in seconds. But physical metal must be mined, refined, fabricated, shipped, and stored. That process takes time and infrastructure. When volatility hits and demand surges, the physical side cannot instantly respond. Now add high margin requirements and extreme volatility to the mix. If a dealer does not hedge properly and silver drops 40% in 2 days, that dealer could be out of business. If silver then rallies 35% in the next 2 days, the risk is just as dangerous. To protect themselves, dealers widen their buy-sell spreads. Hedging becomes more expensive. Risk management becomes critical. This is why we are entering what I call a selective market. Larger spreads, tighter inventory, more cautious buybacks. Dealers become more defensive, refiners focus on industrial demand, and retail buyers compete for limited supply. All of this tells us something very important. The silver market today is not the same as it was in 2011. Back then, enthusiasm was extreme, and supply dynamics were different. Today, we are dealing with structural deficits, rising industrial demand, geopolitical tension, and tighter inventories. So when you see a dramatic drop in spot price, do not automatically assume silver is weak. Look at the premiums. Look at availability. Look at delivery times. The physical market often reveals the true story before the charts do. If you found this breakdown helpful, make sure you subscribe to Gold Silver Scope. Share this analysis with others who are serious about understanding gold and silver, and stay connected as we continue to monitor these critical developments together. And as always, this discussion is for educational and informational purposes only. It is not financial advice. Every investor should do their own research and consider their own risk tolerance before making any investment decisions. The silver market is complex, strategic, and evolving quickly. But when you understand the mechanics behind leverage, government policy, and physical supply, you are no longer reacting emotionally. You are thinking strategically. And in markets like this, strategy makes all the difference.